into this endeavor, to know that they've got regulation that will enable them, that they can go to platforms to raise capital, that they've got support from their community, from mentorship to the people around them to actually go down this path, and have the technology there to enable it all. By the way, we have a self-assessment tool on our website. It's through the World Bank's report. Go to our website, the CCAgroup.com or crowdfundcapitaladvisors.com. You'll see that you can take a self-assessment test, any country, any government can, to see how ready they are for crowdfunding. It's very much based on these variables here. So this is the $96 billion global opportunity for entrepreneurship. We sized it. We looked at it based on where people have access to capital, where they've got extra capital. It's not people that are poor are not going to be putting money into entrepreneurship, into crowdfunding. They don't have the capacity to do so. So we had to build bands to help us understand who are the people in these different countries that have the money to help them invest in startups and small businesses. And so we put these bands in place. And we looked at technology where the social media existed. Because where there was a higher social media penetration, we found when we did our research on this, we realized that the internet wasn't the most important thing. That's great. So there's a presentation. When we did our research, we were thinking, well, having the internet is the most important thing for crowdfunding to succeed in the country. It was actually having the social network was the most important signal for crowdfunding to succeed in the country. So when we started to look at our research and started to analyze the true potential for crowdfunding globally, we realized that the countries that have the highest social media penetration will be the countries that have the most opportunity for crowdfunding, and the countries that are the biggest, like China, will see the greatest potential in dollar size. China is going to be about $47 billion opportunity in the next 25 years. And so, stepping back, this is looking at what are some recommendations that we have in place for governments to look at creating crowdfunding ecosystems. Because people show up and they have the question, what do I do? What do I do? What do I need to do to enable this? So we have them answer questions on what are the economic indicators that are right for entrepreneurs? What concerns do you have in monetary flows? And I don't want to go into this slide in detail because it would take up the entire conversation itself. But you have to drill down on this. And by the way, like I said, on Twitter you can see all this and drill down on it too. You can read all of our recommendations in the World Bank report. I think the most important thing, though, is governments want to know, how do I mitigate risk? How do I prevent fraud when it comes to crowdfunding? That's the big question. This is a great opportunity, but people are going to take advantage of it. And I agree, 100%. Someone will commit fraud. It's been very hard to date for people to commit fraud. There's been tens of thousands of campaigns gone live, and I think the percent of fraud is less than 1/10 of 1%. It will happen. It won't happen with people, I believe, that are connected in their social network, because we don't take advantage of people that we know, love, and trust. So it's important to figure out how we put those rating mechanisms into these crowdfunding platforms globally that allow investors in the United States to see how many investors in the Middle East are a first-degree connection of that entrepreneur in the Middle East. Because the more first-degree connections, the more friends that entrepreneur has in the Middle East, that's probably a signal that, hey, this person's not such a bad person. Look at their Facebook link, Facebook friend request. We all signed in with our real IDs in Facebook. But how do we mitigate risk in crowdfunding? Well, you have to have crowdfunding regulation in place. You have to have government oversight. So you have to have regulatory bodies that oversee the transaction of securities. Okay, those need to be there. You need to have regulated crowdfunded portals. You can't have fly-by-night portals that are just coming into the space saying, I want to do crowdfunding for securities. This is a regulated activity. It's been fascinating for us to learn that crowdfunding, but the securities market is the most regulated entity globally. I would have thought it's arms dealing and all that. mean, those are huge markets, but the buying and transacting of securities is the most regulated activity globally. So you can't actually take crowdfunding and say, we're going to do it outside of this regulated activity. You have to say, we need to do it within it, but we need to have a discussion about how we can leverage technology today to allow us to transact these interchanges without worrying about the problems of 30 years ago. The next thing is background checks. When we went to legalize crowdfunding here in the United States, one of the first things that we said is background checks must be mandated. And I remember having people in the SEC in Congress say to us, well, how are you going to do that? I mean, we've never actually written this into law. It's best practice. We see it in what FINRA has come out with, that background checks and know your customer. It has to be in there, but we want to actually put this in the written law. And we said yes. We think it's important that background checks need to be in there so we can verify that these people are real individuals. We need to figure out how we can leverage this technology and individuals and co-working space, other people today, to do background checks on individuals so that we can know and trust them with the capital that they're going to get. We have to have standard mandated disclosures. Investors make decisions on investing in people. They make decisions on investing in business ideas. They do that because of the revenue model that is attached to it. They believe that people will execute on it. But the reality is they review documentation before they do this. And that documentation tends to be pretty standard. They want to see a business plan. They want to see a use of proceeds. What are you going to do with the money when you get it? They want to see a valuation. Like, how did you come up with this valuation? So there's certain standard disclosures that we have to have across the board so investors have access to that information. It's not that they're all going to read it. I think many crowdfund investors will invest in someone because they know them, because they just want to help them out, because they think it's a cool idea. But at the end of the day, these are documentations that we have in the public markets, and they're documentations that we probably going to need in the private markets as well. You need to have a social network. This whole back end of this, like I was saying before, requires a robust social network, because while crowdfunding is about community engagement, our communities are not just within our own backyard now, thanks to the social network. They are communities of origin. They are communities of interest. They are communities of diaspora. I think the fascinating thing and the real opportunity for global crowdfunding comes to the diaspora people. We've got people that have come from countries that live in the United States, that live in Canada, live in the UK, but have their roots attached to their homelands, have family back in their homelands, have an affinity to their country where they're from, and they want to support those businesses. They want to support those people. They want to have the opportunity to send money not just to a family friend, but someone that wants to actually do something good for their country. And if we can figure out how to harness that diaspora dollar, we will truly see that $96 billion potential come to life. That comes through the social network, because we are engaged in these communities of interest, origin, and diaspora through our social networks. We join groups of interest. We join groups of origin. And these are the groups that entrepreneurs will target for funding for their business opportunities. Next, we've got investor accounts and education. Again, critically important point. We don't want everyone taking all their money and putting it in on black in Vegas. Investing in startups and small businesses, we say it all the time. This is one of the riskiest activities you can do. The chance of failure is great. Don't put your money in if you need it. So we tell people that the most important thing is to diversify. If you're going to put money into crowdfund investments, take a small percent of your assets and put it in there. This should be part of your assets that are allocated toward high-risk investments. But we need to cap it out, we believe. We need to let people know, by putting these caps in place, if you're not a sophisticated or an accredited investor, that you shouldn't risk your money. And so by putting these caps in place and using technology to limit it, we can actually stop people from probably losing more than they can afford to lose. The next thing is education. Education is the key to so many things in life itself. It's a huge part of what we need to do as soon as Title III and crowdfunding here in the United States goes into effect. But it's a global opportunity as well. And here's another thing about this. A lot of what I'm talking about isn't new. A lot of what I'm talking about is already in place. The pieces are already out there. How do we connect these pieces, these players together to enable this global crowdfunding ecosystem? Crowdfunding education probably does need to be created, but we've got the ability to take other parts of the education ecosystem and pull it in to help train entrepreneurs, to help train investors, to help build a better, stronger crowdfunding ecosystem. And the last thing that we need to have in place on a global scale is a way in which we can do reporting. Because the last thing that you want is to give someone money and never hear from them again. It just creates a little uncomfortableness in the process. You want to know that if you're giving someone some money, what are you doing with it? Let me have an update. And so we need to have mandated reporting in the system that goes to the investors, that it goes to the regulators, that it goes to the people that are counting the money, that are counting to see the jobs that are created, so that we can track the progress of crowdfunding globally. This is not just about portals. This is about connecting all these pieces together. Each of these things in itself is a regulated body, could be a technology, could be part of the crowdfunding ecosystem. And we refer to this much as the white space of crowdfunding. You've got the portals that are in the middle, and then you've got all the white space players that are around it, okay? Everyone globally will have this. We need to connect. Now, it's been a hypothesis up until recently. And now that we've got more businesses that are getting into crowdfunding and are looking at this as a way to raise money for the businesses, we thought it was a time for us as an organization at Crowdfund Capital Advisors to do a little research. So part of what we've done is we formed a policy and a research group at UC Berkeley. And it's a program on social finance and innovation. And it's meant to study not just crowdfunding, but all social finance and innovation globally. And so what we wanted to do is we wanted to understand, can crowdfunding create jobs? Does it lead to increased sales? Is that an outcome of crowdfunding? People have talked about crowdfunding as a deterrent to follow-on investors, because you wouldn't want a bunch of unaccredited investors, unsophisticated investors in your cap table. Is that true? Does crowdfunding actually deter follow-on investors? So that's why we did research last summer, and we sent a survey out to over 1,000 companies that were successful with crowdfunding. We whittled that down, and we decided to go with 87. Now, I will tell you right off the bat, these are 87 companies that were successful with crowdfunding that wanted to be part of the study. Okay, so this is a biased study right off the bat. So any of you that are academics in Berkeley are head of the program, just like, it's very biased. And it's like, the point of it is we're trying to understand what these companies were able to accomplish and why they thought they were able to accomplish it. And so this is, as with all of this, you are looking at the very leading studies of what will be a huge global industry. And we will have a much better understanding about this as soon as we've got more data that's being fed into all of these portals and ecosystems globally. But let's look at what we found. This was the title of the report. How does crowdfunding impact job creation, company revenue, and professional investor interest? Again, if you want to get this, you can just go to our website and download it. So here are the key questions and answers. Does crowdfunding translate to sales? If a company goes out and raises money from the crowd, can they actually accomplish something that leads to further sales? Can they engage their investors in a way that becomes brand advocates for them, so that they go out and start marketing the business for them because they have a vested interest in the success of that business? That was the hypothesis. The fascinating thing was 24% of them didn't see long-term growth. They saw immediate quarter-to-quarter increase in sales. That was pretty impressive, we thought. Then we filtered it out. We wanted to see if we just filtered it out for equity, what happens? 351% increase in sales. This is among the, I'm sorry, not 24% all of them. That was 24% overall increase in sales of all of them. If you filter it out for equity crowdfunding alone, it was 351% increase in sales. What we heard over and over again from the people that did the equity crowdfunding is they had investors that were truly engaged in their businesses now. When you invest in Apple, when you invest in a public company, You are investing in the ability of the company itself to actually achieve their goals and hit their analyst targets. Okay? There's nothing you or me or anyone else can possibly do to make a difference in that public company's earnings. But when you invest in a crowdfunded business, you are actually one of the few investors in that business, and you actually can go out there and do something to have an impact on that business's bottom line. And that's what engaging crowdfund investing can do, and that's what we're starting to see in these early signals. This was, I think, one of the golden moments of this thesis, this report for me. Because we went to Washington, D.C., hell of a jobs. So we kept on saying, give companies access to capital, let them innovate, let them create businesses. We created businesses when we had money, we hired people, and then we were able to create bigger businesses and grow these things. And these people were able to go out and buy homes and put some kids in school. So does this actually lead to jobs? Yes. These companies that were successful in crowdfunding hired on average 2.2 people. So it's fascinating to see that they're going out there and they're using the money to actually employ people. Why? Well, because they probably put together a use of proceeds that said, listen, I need to hire some people so I can go out and execute a pot vision. Okay? And that's exactly what they're doing with this money. So it's exciting to see that they're engaging people and the crowds create jobs. Another interesting thing from this point too is people that maybe take in the money from the crowds, they don't hold on to it. This money is used within 90 days. So think about that. When you've got the economic stimulus that our government is pumping into our economies globally, the reason that they're doing that is they're trying to create movement in the economy. They're trying to get money moving so that people are spending it so that we can have a bigger economy. That's what crowdfunding seems to be sick of. That these people that have this money are not holding on to it, but they're putting it into the economy within 90 days. They're spending that money. I think that's good for the global opportunity for crowdfunding. So now the last question. Does this deter follow-on investors? Are angels or VCs turned off by the fact that they've got a bunch of